listening to The Voice. It's Lisa Mackenzie here with you. And today I'm joined by the lovely Felix Milton. Good morning.
Good morning.
How are you?
Very well, thank you.
Good. So, you're now with me.
I am, yes, all change.
It has indeed, it has. So, for those listeners that maybe haven't heard about what it is you do, so you come and give us advice on everything money related.
Effectively, yes, and talk about my views on certain financial aspects on a monthly basis.
Yeah, that's good though, isn't it? So if anybody has got any questions, they can feel free to give us a call here in the studio. But today we are going to be talking about the markets.
We are, because they're very volatile at the moment because of the Brexit uncertainty.
Mm-hmm.
So a bit about risk and why risk is important and what this could mean for you.
Okay, so now when I'm talking from a me point of view, I'm not very good with things like markets and things like that. So the market is where you invest money into certain things and you can make money. Is that right?
Effectively, yes. The stock market is a list of quoted companies that can go up and down on a daily basis, and the public can buy shares in that company. So if that company does well, they benefit. So,
yeah.
And that's typically for bigger companies.
Okay. So what about, because sometimes people get phone calls, I mean, I get them quite often. People ring up and say, "Hi, are you interested in buying diamonds?" And I'm like, "No." Most I guess proper companies, proper market share people won't just give you a call, will they?
They won't, no. So if you're called out of the blue, it's probably a scam,
yeah.
And wouldn't advise proceeding with that.
There we go. So good. So I needed to double check that one because some people do get caught out, don't they?
They do, especially vulnerable elderly people usually, because they've come from a different generation, which is very nice when you can trust everyone. But nowadays it's scammers usually that. And what's important to note here is that if you have fallen for a scam in the past, it is likely they will be targeted more because they know you've fallen for a scam. And there's a thing called a suckers list, as it's known, which can be sold. And that's typically what these people will buy and then try and persuade you that this one isn't a scam, when it probably is as well.
So, and of course, sometimes I had a phone call once and they said, "So thank you for supporting us." And I was like, "I've never supported you." And they said, "You have." I haven't. But again, some people may fall for that, mightn't they? They may think that they've forgotten something.
They may, yes, yeah.
So when you talk about taking risk, so is taking risk a good thing?
It is. Risk is a very good thing, and everyone takes risk every single day. When you cross the road, you are taking a risk that you may get hit, but you do things to mitigate that risk by looking both ways. So risk is very important, and especially with your money, risk is perhaps the biggest thing that takes into account how much you may have after a time frame. So risk is good. There is nothing bad about risk. It's how you manage the risk, which is the important thing. And leaving your money in cash is not risk-free. There is risk doing that because inflation can reduce the value of your money year on year. So if you do nothing with your money, it actually goes down in value anyway. So you need to do a collective basket of things to make sure your money is working hard for you.
And so people, if they want advice, they come and see people like yourselves, and can you give them advice on where the best place to put this money is?
Yes, and that's typically what we do on a day-to-day basis. So people come to us with their pensions, their ISAs, their investments, their anything they've accumulated over their lifetime, and we can guide them as to where best to invest it for their future and to meet their goals going forward. Yeah,
definitely. I mean, as a mum, obviously my future, I want to make sure that my children have got things, have got a pot of money there should anything happen. And that's another avenue that's a good way that you can help with, isn't it?
It is, yes. So we can look at things such as junior ISAs for children that parents can pay into, so at the age of 18 they can get that money. Or we can even look at things like life insurance or income protection. If a parent were to tragically die, for example, at least then the children are going to get some money that should help fund them through education or whatever and pay the mortgage off, so there's not financial pressure on the survivor.
Yeah, see that, and that I think that is a really important thing, isn't it? Is to make sure that your children are set up and they've got something there ready.
Yes.
So what would you say, excuse me, what are your top tips for investing money or taking a risk? What would you say, what would you advise on the risk taking?
So it depends on your personal situation. If you are a young person investing, say, in a pension for your retirement, investing in a higher risk vehicle may not be inappropriate for you, because it doesn't really matter if the market falls tomorrow, because you know you're not going to access that money for 30 years.
Right, okay.
So whereas if you are looking to retire in 6 months and you were to invest everything and the market were to crash tomorrow, that would probably have a detrimental effect on your standard of living and your retirement. So it's important to gauge risk based on what your personal objectives are. But certainly taking no risk at all is a risk in itself, because inflation is a silent killer that most people forget about, because they think, oh, my money's in cash under the bed, or my money's in the bank and the bank looks after it. That's all well and good. But if inflation is higher than the interest rate you are earning, that money is going down year on year, but you won't necessarily see that until you come to spend it and find that it can't buy as much as it once could.
Yeah, that's when you put it like that, that actually makes a lot of sense. And like I said, this is great for me, because I find this really interesting, but I don't always understand it. So thank you. I'm really pleased that we're doing this, Felix. You know,
It's not a problem.
So what else is going on at the moment that maybe we need to let our listeners know about?
So it's important to not take the media headlines at face value as such. If the media is saying the market is crashing and it's all horrible, I'd ignore that, because it's only going to put panic in your mind, and reacting to that is probably not the wise thing to do. If you know that your investments were set up for the view of a longer time frame than just a few years, you can afford to ignore all the noise that's going on. So even those that invested in, say, 2007, just before the last recession, if you encashed in 2008 when it had halved in value, well, you've lost half your money, because you've actually realised the loss that they've gone down. Whereas if you go, okay, I knew these were long-term investments and I could hold them for the longer term, those that actually held on and stuck through and seen their money go down, but also recovered. And if they didn't encash at the bottom, they didn't actually lose anything. So typically, if you know it's for the long time, just ignore all the noise going on about Brexit, saying that we're going to lose X, Y, Z, or this is going to happen, because the truth is nobody actually knows. So markets don't like uncertainty. So even if there's a certain negative for, say, companies, that doesn't matter as such, because at least companies can plan for that. Whereas at the moment, they don't know what to plan, and they don't want to plan because it may change day in day. So that's why it's important to ignore the noise.
Right, okay. So we're going to play a song now, and then I'm going to come back to you, and we're going to have a little bit of a recap, and then you can let us know how people can actually get a bit of extra advice. Is that all right?
Yeah, that's fine.
Joined in the studio by the lovely Felix. Hello.
Hello.
Hello again. So we are talking about risk and the market and stocks and shares, and there's some things that, I mean, like I said to you earlier, I'm not very clued up on things like this. So in layman's terms, so somebody's thinking, what is a share? How would you explain that? How would you explain the markets?
Okay, so take a big company like a well-known supermarket, for example. They want to raise money. So what they do is say, we're going to sell ourselves to individuals who can buy a tiny portion of our business, and we can use that money then to expand, or so on and so forth. So that supermarket goes and floats on the stock market. So it will divide itself up, say, into 100 pieces, and you can buy one of those pieces and you will own a stake in the future of that business. So you have a share of the business, and then you benefit from the profit the business makes. So they will pay out dividends, and you will also benefit if that share goes up in value, which it would if lots of people were buying their shares. Conversely, that share could also go down in value. So that is a share in the simplest explanation, I'd say.
And that's very good. I understood that. See, you said shopping. I understood that. So if somebody wanted to buy a share, now where's the best place to kind of look, or is it better to come and speak to somebody like yourselves who can give that advice?
If you don't know what you're doing, I wouldn't say go and buy a share purely because you like the company or you think it's nice, because it could be a good company, but a good company does not necessarily mean it is a good share to buy. A prime example of this at the moment is Aston Martin. They make lovely cars, absolutely fantastic. But from an investor's point of view, they're an awful company that you wouldn't touch with a barge pole. Lots of debt, and they floated, and they've lost 70% of their value since they went onto the stock market. So they make a great product, but from a company perspective, you wouldn't really want to invest in it unless you were very sure of their finances and their future and so on. So that's a prime example at the moment as a share really that makes a great product but doesn't necessarily mean it's a good company. So it's just something to bear in mind there. That's
again, you know, that is one of the companies that I would have thought, you know, would be great to follow, because like you say, they're such a big name, they make such expensive cars. You automatically think that by backing them, that you're going to get more value for money.
Exactly. I mean, hopefully they can recover and turn themselves around, but at the moment they've they've got a lot of debt and so on, and so the market has actually taken 70% of their value off them since they floated, which isn't really good for them as a company, but again, still makes a great product. So it doesn't necessarily follow through as a good company making a good investment decision.
Yeah. So sometimes there's somebody, say, had £100. That's what they had, and they wanted to invest it in something. What would you suggest? Getting a smaller share with a smaller company, or would you say that it's going to be better to put to maybe split that up and have, I don't know, follow four different people? What would you?
So if you're in a smaller company, that means more risk inherently in itself, because there are more things that could go wrong and could impact it. So generally, if you're looking to invest, you'd want to choose a range of holdings. So typically about 20 will mean that you've mitigated all the likely individual company risk. So if one company does something wrong and goes bust, then it shouldn't matter too much because it's only a small percentage.
Yes.
If, however, you've got two companies and one goes bust, that's half of your portfolio. So it's a very big impact. So it's important to diversify.
Yes.
Typically, if you're looking to invest, say, for the longer term and you want some relative security, I say relative because nothing is certain.
No.
The FTSE 100 is the 100 biggest companies in the UK by market capitalisation.
Okay.
So that simply means the total value of all their shares. So they have several £billion companies on there, and the biggest changes every now and then for HSBC to Royal Dutch Shell. So there's lots to take into account as to what is the biggest, but those companies can weather storms much better than, say, the slightly smaller companies that may be on the FTSE 250, which is the next 250 after the 100.
Oh, now that makes sense, because I've always looked at the FTSE 100 and I've always actually wondered, why is it called a FTSE 100 and why is it called? But now you've just said.
Yes.
There we go. So I did tell you this is all very new to me. So is there a minimum amount that anybody can put into something, or does anything go?
In theory, if you can afford to buy one share that is 30 pence, you can buy one share. Not that I suggest that or not, because there's fees on top to buy shares and so on.
Right, okay.
So typically, if you're investing for the longer term and you're feeding money in as a regular amount, it doesn't really matter where you start. If you're looking to invest a lump sum, again, it depends why you're looking to invest in the first place and what your goal is with that. But obviously, the more you can invest, the more you can buy and the more diversity you get. And you need to make sure, obviously, the fees aren't going to impact that investment amount so much. So the smaller you invest, if the fees are, say, percentage wise, it's not going to matter. But if they're a fixed basis and you're investing a lower amount, those fees are going to be a much bigger percentage of the overall pot. Right, so it's important to consider why you're investing in the first place.
Yeah. And obviously that you can afford to, that's the most important
exactly thing. You need to size up that you can afford to lose it all. So if you can afford to lose it all and realize that yes, it probably won't happen unless the world entered an apocalypse or something, then really you shouldn't be investing if you can't afford to lose any of it.
Right, okay. Felix, thank you so much. That's helped me, and I'm sure that's probably helped a lot of our listeners as well today. Now, I'm going to put it out to our listeners. If there's anything that maybe they would like to ask you, any sort of topics that they would like to cover, should we get them to call us? And
yes, of course.
And we can cover those on our little meetings.
There we go.
That would be quite nice. So you're going to be coming in once a month?
The second Wednesday of every month.
The second Wednesday of every single month. Felix will be here. So if you have any questions, you can give us a call, 01271 323 010, or you can email me. And so it's just lisa.mackenzie@thevoicefm.co.uk, and I can pop those questions to Felix once a month.
There we go.
That sounds like a plan, doesn't it?
Excellent.
Thank you so much, Felix, for coming in today, and enjoy the rest of your day.
Thank you.